$5.5 billion. That's Anthropic's reported annual cash burn rate. Let that number sit for a moment because it represents something most tech workers don't fully grasp. A company spending more than $15 million every single day to operate. And here's where it gets concerning. Right now, if you're holding secondary market equity in Anthropic, whether from employee stock options, restricted stock units, or secondary share purchases, that equity is being priced as if the company has between 5 to 7 years of runway before needing to raise capital again or achieve profitability. But the actual math suggests something very different. We analyzed Anthropic's public funding disclosures, SEC filings were available, and compared their burn rate against established venture capital benchmarks. What we found should matter deeply to anyone holding equity in this company. The $5 billion question. Let's start with what we know. Anthropic has raised approximately $3 billion in total funding as of late 2024. This includes their Series C round in May 2024, $5 billion from Google, their Series B rounds, and earlier institutional capital. Against a $5 billion annual burn rate, this funding level provides less than 3 years of runway at current burn rates. But wait, you might say the company is likely raising more capital. And yes, that's possible. But let's examine what that actually means for equity holders. Comparable company analysis. The efficiency question, let's compare Anthropic against other major AI companies to understand whether this burn rate is standard or alarming. OpenAI's burn rate. OpenAI has been reported by multiple sources to operate with a burn rate significantly lower than Anthropic's. Bloomberg reported in 2023 that OpenAI was burning approximately $700 million annually before their $80 billion revenue deals with Microsoft and others were fully realized. Even accounting for growth, OpenAI's burn rate appears substantially lower, roughly 7-8 times less than Anthropic's current burn. Why the difference? OpenAI achieved earlier monetization through ChatGPT Plus, launched November 2022, and enterprise licensing. Their consumer product gained critical mass faster, driving actual revenue that could offset operational costs. Google DeepMind. Google's AI research division doesn't face traditional venture capital constraints because it's backed by Google's $307 billion cash position. However, internal reporting suggests DeepMind's research spending reaches perhaps $1-2 billion annually, substantial, but spread across infrastructure that serves multiple business units. Importantly, DeepMind's burn doesn't threaten the parent company's solvency. Meta AI, Ella team, Meta open-sourced their Ella MA model and has integrated AI research into broader Facebook/Instagram/WhatsApp operations. Their AI burn rate, while significant, is absorbed into a $116 billion annual revenue business. They achieve scale efficiency through platform integration. Anthropic stands apart. As a standalone company dependent on venture capital with capital expenditure requirements for compute infrastructure, its $5 billion annual burn is in a different category entirely. What the funding math actually tells us. Let's walk through the actual runway calculation that secondary market investors seem to be missing. Assumed capital as of Q3 2024, $3 billion annual burn rate, $5 billion simple division, 3 divided by 5 equals 1, 33 years. But here's what happens next in the venture capital lifecycle. Scenario 1, continued funding. If Anthropic raises another major round, say $5-10 billion, they extend runway to 2-3 years. But each new funding round typically includes significant dilution for existing shareholders. Employees holding restricted stock units, RSU, will see their ownership percentage decrease. Secondary market share prices will be impacted by the valuation at which new capital is raised. Historical precedent matters here. Look at WeWork's funding trajectory. Between 2014-2019, WeWork raised $8 billion across multiple rounds, yet each successive funding round came at a lower valuation. Series K in 2019 was at a $47 billion valuation compared to the $47 billion unicorn valuation from 2015. The company never approached profitability. When public markets rejected their 2019 IPO, shares that secondary markets had priced at $47 billion valuations became worthless. The key difference, WeWork's burn rate was only $6 billion annually before they cut costs dramatically in 2019. Anthropic's burn is more than double that. Scenario 2, profitability path. Could Anthropic achieve profitability before capital runs out? This requires either A, dramatic revenue growth, B, dramatic cost reduction, C, both. Let's examine the revenue potential. Anthropic's revenue comes from Claude API access through AWS and other cloud partners' enterprise licensing agreements, potential future Claude consumer products based on available data. Anthropic's 2024 revenue is estimated in the range of $200-400 million. That's substantial, but it represents only 4-7% of their burn rate. To achieve profitability at current burn levels, Anthropic would need to increase revenue by 500% to $10+ billion annually, or reduce burn by 80% plus to roughly $1 billion annually, or achieve some combination. For context, here's how long it took other AI companies to achieve profitability at similar burn levels. OpenAI, still not profitable as of latest reports, but with clear pathway through Microsoft partnerships. DeepSeek, initially funded by Chinese state capital, reducing pressure, but facing substantial Western export restrictions. Anthropic, No clear path to $5+ billion in annual revenue in the next 24-36 months based on current market dynamics. The secondary market mispricing. Here's where employee equity holders should pay close attention. Secondary market prices for Anthropic equity have valued the company at approximately $30+ billion based on recent transactions. Let's think about what this valuation implies. A $30 billion valuation at $5 billion burn rate means the market is pricing in either dramatic revenue growth, 5-10x from current levels, or multiple future funding rounds at this valuation, or higher or significant cost reduction. Historically, venture-backed companies trading on secondary markets have shown systematic overvaluation relative to fundamental metrics. Research from Cambridge Associates found that 34% of venture-backed companies that raised Series D funding subsequently experienced down rounds where later funding came at lower valuations. For companies with burn rates above $1 billion annually, this rate increased to 47%. Anthropic, with a $5 billion burn rate, sits in the highest risk category. Historical precedent. When burn rates destroy equity value, let's examine specific cases where secondary market equity became worthless despite robust funding. Theranos, 2003-2018. At its peak, Theranos raised over $700 million and was valued at $9 billion. Despite this substantial capital, the company burned through money rapidly while facing technical and regulatory challenges. When SEC investigations began in 2015, secondary market shares that had traded at valuations implying a $9 billion company became worthless. Investors who bought secondary shares at $15-20 per share, implied from the $9 billion valuation, lost everything. Key lesson: excessive burn combined with execution challenges can destroy equity value faster than market pricing reflects. Quibi, 2018-2020. Quibi raised $1.75 billion for a short-form video platform. The burn rate was enormous, approximately $500 million annually. Despite robust funding, the company failed to achieve product-market fit and shut down after 6 months, making all equity worthless. Secondary market investors who purchased Quibi equity at valuations implying a $1.75 billion company learned that funding not equal to viability. Zoo Energy, 2010-2015. Zoo Energy raised over $300 million for advanced energy storage. Burn rate exceeded $80 million annually. Despite venture backing, the company couldn't commercialize its technology efficiently. Equity became worthless when the company liquidated. What's common? High burn rates, combined with execution risks and unproven business models, create equity value destruction even when companies have substantial funding. The Anthropic specific risks. Anthropic faces several execution risks beyond pure capital math. Competitive pressure. OpenAI has a product market advantage and Microsoft partnership. DeepSeek's models are increasingly competitive while using dramatically less compute infrastructure, lowering their burn. Google has integrated Claude through partnerships but controls distribution through their own ecosystem. This competition limits Anthropic's pricing power and TAM growth. Regulation risk. As AI regulation evolves, EU AI Act, potential US legislation, Anthropic may face compliance costs that increase burn further. Unlike other tech companies, AI-specific regulatory costs are unpredictable and could be substantial. Customer concentration. A significant portion of Anthropic's revenue likely comes through AWS and Google partnership, meaning pricing power is limited and customer concentration risk is high. Talent cost pressures. AI researcher salaries are driven by competitive market dynamics. Anthropic pays top-tier talent to remain competitive. If they cut costs to reduce burn, they risk losing employees to competitors, which could impact their core product development. What this means for equity holders if you hold Anthropic equity. Here's what the math suggests. Base case, 60% probability. Anthropic raises additional capital at a lower valuation than current secondary market prices, resulting in significant dilution. Your equity becomes worth 40-60% of what secondary market prices currently imply. Bull case, 25% probability. Anthropic achieves dramatic revenue growth and slash or cost reduction, validates the current valuation, and exits at a $50-100 billion valuation. Your equity gains significantly. Bear case, 15% probability. Anthropic burns through capital, faces down rounds, and either fails to exit profitably or exits at a much lower valuation, $5-10 billion range. Your equity becomes worth 10-30% of current valuations or becomes worthless. The expected value calculation is straightforward. 0, 60 times 0, 5 plus 0, 25 times 2, 0 plus 0, 15 times 0, 2 equals 0, 30 plus 0, 50 plus 0, 0, 3